Okay, so tonight we are going to be looking at um, plant assets. You know what? I should have asked this because no one has said anything. Can everybody hear me okay? I'm not muted or anything weird like that. Throw a thumbs up if you can hear me. Blink twice if you're being held against your will. Great. Okay. Thank you. Um, in that case, let's see. Am I? Let's see, let's share my screen here. Okay, tonight we're going to be looking at um, plant assets and natural resources, generally, um, property, plant, and equipment. Um, assets are, or PP&E is what we call these on the income statement. Okay. Um, and we're going to look at how we measure the costs of those long-lived assets. So when we're talking about um, property, plant, and equipment, we're talking about something that's not going to be used up over the course of a year. Okay, and some examples of this are land, buildings, equipment, vehicles, um, furniture, things like that. Okay. Um, they do tend to last several years, and they tend to be a rather high cost, right? So, in order to account for these assets, we want to allocate or stretch that cost over the useful life of that asset, okay? And we call that allocation of the cost depreciation. All right. And this follows the matching principle. So we have to know a few things before we can calculate depreciation. Okay. We have to know the life cycle of the particular asset. All right. So we have to know um, the cost of the item. All right. So the first step is the acquisition. All right. And there's a cost associated with that. And then there's that useful life that we talked about. So all of the years that we use that item. And then at the end, we dispose of that asset. Now, maybe we can make some money back by selling it, or maybe it's going to be an additional cost to have somebody cart it away. Okay. That's another aspect that we need to be aware of for the accounting of this item. Okay. When you acquire that asset in the beginning, okay, we want to record that at its historical cost. That's the amount we paid for it, okay? Um, so that is a gap principle. I don't know if you remember that many, many moons ago in the beginning, when we talked about these gap rules, we talked about how we record our assets at their cost. Now, if we're talking about a vehicle, there is more than just the sticker price, right? We also have the taxes, the title, the license, the delivery costs if we had it, dropped off at our front door, those kinds of things. All that gets bundled into the cost of the item on the books, okay? Um, the example that they use here is a piece of land. In this case, the cost of the land would include the purchase price, the commission to the broker, any survey or legal fees, any delinquent property taxes that you have to pay to get ownership of that property, the title transfer fees, and the cost of clearing the land to make it useful to you. Okay, all of these things would be included in the cost. All right. Um, the cost of the land would not include specific improvements like fencing or paving or sprinkler systems, lighting or signs. Okay, those are separate assets. Okay, and we call those land improvements. All right, and we depreciate those. Fun fact, land never gets depreciated because its useful life is forever. Okay? When you're calculating the useful life of the earth, I realize that there's a finite amount of time before the sun expands and swallows us up, but it's in the billions of years. So as far as we're concerned, the life of the earth is infinite. Okay. And if you remember, if you took calculus, if you try to divide by an infinite number, it's not a meaningful response. Okay. So land is not depreciated. Okay. So let's look at an example. Okay, Smart Touch Learning purchases land on August 1st, 2026 for $50,000 with a note payable. The other costs include $4,000 in delinquent property taxes, $2,000 in transfer taxes, $5,000 to remove an old building, and a $1,000 survey fee. Okay, so as you can see here, we have the purchase price of the land, and then we have all these additional relevant costs. Okay. All of these additional costs together are $12,000. So the total cost of the land on our books is going to be $62,000. Okay, here's our journal entry. This shouldn't come as a big shock, right? We bought the land for $62,000. That's going to sit on our books as the value of that land. We bought it with a note payable of $50,000. That was the actual purchase price of the land. And then we paid all those ancillary fees in cash. Okay. So this is the journal entry for that. Smart Touch Learning capitalizes the cost of the land at $62,000. That just means that it goes on our books at $62,000. Okay. Let's see. Next up, Smart Touch Learning pays $20,000 for fences, paving, lighting, and signs. Okay, this is the initial acquisition. Okay, so our first journal entry for these other assets that we depreciate. Okay, we're going to call them all land improvements. Okay, we are going to debit land improvements. That's just another asset account. And we're going to credit cash. Okay, so this is a situation where we bought an asset for cash. We're just trading one asset type for another. Right? Land and land improvements are two entirely separate assets, and our land improvements are going to be depreciated. Okay. So we'll get back to depreciation in a minute, but for now, let's move on to buildings. Okay. The cost of a building is going to include the construction on that building if you don't, just purchase an already made building. The architectural fees, the building permits, the contractor charges, the payments for all those materials. Okay. If you purchase an existing building, it's going to be the purchase price and any cost to renovate that building to make it ready for use. All right. Additionally, any brokerage fees or realtor fees or anything like that associated with it, all of that will go into the cost of the building. Okay, so machinery. Let's say that you're a manufacturer, okay, and you need some machines to build your widgets and thingamabobs, okay? The price of that machinery is going to, of course, include the purchase price, but also any transportation, charges, any insurance for those items, sales taxes, purchase commissions, the cost of installing that equipment and getting it ready for actual production, okay? Including any testing costs and any materials that you need, oils or bolts or, I'm not, clearly I'm not that mechanically minded, right? But whatever it is that you put into a machine to get it ready to start serving its useful life, all of that gets added to its initial purchase price, the acquisition phase, okay? Another thing that might go in your building is furniture and fixtures, like, desks and chairs and filing cabinets. All of those are going to be depreciated. The equipment from the last slide also depreciated, okay? The cost of that furniture is going to include the purchase price and all the other costs needed to ready that item for its intended use. So delivery costs, assembly costs, anything like that. Okay, so lump sum purchases. All right, so let's say your company buys a lot. Not a lot as in many, but a lot, a bundle of assets as a group. This is called a lump sum purchase. Okay, you can also call it a basket purchase. All right. So in order to put this on our books properly, we need to identify and declare the cost of each asset in this bulk purchase. Okay, so what we're going to do is we're going to take the total cost that we paid and we're going to divide it among the assets according to their relative fair market values. Okay, so now we're bringing market value into this. All right. Okay, so we're going to look at an example, and I think that will clarify that a little bit. So Smart Touch Learning pays $100,000 for land and a building. Okay. An appraisal of these two items indicates that the land's market value is $30,000 and the building's market value is $90,000. Okay, so we look at this ratio, okay, and we see that the building is worth 3 times as much as the land. That means when we're distributing this $100,000, it's going to be at a 3-to-1 ratio. Okay, does that make sense, or am I making it more mathy and confusing than it needs to be? All right, so our total fair value for the land and the building is 30,000 plus 90,000, that's 120,000. So the land's fair value divided by the total fair value is 25%. And the building's fair value is 75%. Does that make sense? All we did was take their market value and divide it by the total market value of both pieces. Okay. Then we're going to use that market value proportion to apply the actual cost to those items. Because remember, even though they were valued at $120,000 together, we got them for $100,000. Okay. So we're going to distribute that as 25,000 for the land and 75,000 for the building. Okay. The journal entry for that will look like this. Land of 25,000, building of 75,000. We're adding these two assets to our books. And then our note payable of 100,000. Our liability, okay? All right. So capital and revenue expenditures. So we're going to divide our spending on plant assets after the acquisition into 2 categories. Okay. We have capital expenditures. That's money that we put into that asset to increase its efficiency or extend its useful life. Okay. Um, that includes extraordinary repairs. Those are the repairs that specifically extend the life of that item. Okay. And then we have revenue expenditures. Those are the expenses that maintain the asset in working order. So let's put that into perspective. Okay. So if we had a car, okay, that's our asset. If we replace the engine in that car, that would be an extraordinary repair. That would extend the useful life of that car and therefore be a capital expenditure. Whereas putting gas in the car, changing the oil, those are revenue expenditures. That's just the day-to-day that you need to do for that vehicle just to keep it running. Okay. So if we spend $3,000 to rebuild the engine on a 5-year-old truck, that's an extraordinary repair because it extends the asset's useful life. So we are going to increase that asset's value, the truck by 3,000, and we're going to reduce our cash by 3,000. Okay. However, on the flip side of that, if we pay 500 cash to replace the tires on that truck, that's just a wear and tear item. Okay. So we expense that to repairs and maintenance and reduce our cash by $500. Do you guys, is that pretty clear the difference between those two, the capital expenditures versus the day-to-day expenditures on those items? Okay. Oh, sorry, I didn't see that comment before about us all being behind. Yeah, I don't know. I appreciate your patience because I usually hate to get behind on class stuff. I know this is important to you guys. I don't want to treat it like it's not important. Okay. It's just whew, things are hectic, but thank you. I really, really appreciate that. Okay. So, back to our capital versus revenue expenditures. This is just a summary tab that sums up what I said over the last couple of slides. This is a really good study aid, a really good reminder to have when you are doing your assignments as well. Okay. Okay. Data analytics, one of my favorite subjects. Companies that own a large amount of properties use data analytics to maximize their profits. They collect data about geographical locations and where distressed properties are likely to be found, where there are high vacancy rates or where real estate is particularly cheap. They can use it to identify tenant mixes, whether people are more likely to rent or buy, things like that. They also collect weather data. And here's the thing, here's the exciting part. So, for a long time, all data that we dealt with as accountants was estimated or sampled. We kind of took a small piece to look at the big picture because humans are kind of slow at doing our arithmetic, right, as compared to machines. But now this really excites me. More and more advanced AI allows us to take these giant data sets and just smush them in and have you know, uh, models that used to take giant mainframe computers to crunch the numbers for. Now your phone and an AI tool can analyze 20 years worth of demographic data So, it's brilliant. It thrills me actually. I know that some fields are feeling the crunch, and I'm not unsympathetic to that, but I feel like for careers like ours, AI is going to be a huge boon, and it's really going to help us to drill into and be more precise about our reporting. Anyway. Um, that is enough of me gushing about data analytics and AI. Okay, so let's start talking about depreciation. So we've gone through a bunch of different ways to acquire assets and how to put those on our books and which costs to include. Okay, now we're into that useful life period where we have to allocate, smooth that cost, that giant cost that we've spent over the whole life of this item. Okay. Um, and we're going to do this with all long-term assets except for land because land never wears out. Okay. Um, Also, just be aware that there's a thing called obsolescence or becoming obsolete. Some items will become obsolete before they actually wear out. An example of this would be like a CD player. I'm I know some of you might be thinking, what is a CD player or an MP3 player? Okay, those little things will last forever. Okay, but nobody uses them anymore because your phone does all of those things. So the technology is now obsolete. Anyway, just a vocabulary distinction for you to be aware of. Okay, back to depreciation. So remember when I was walking you through the parts of the life cycle, I alluded to this, okay? Three factors that we're going to take into account when we're thinking about depreciation. First is the capitalized cost. So the amount that we paid to get that item and get it into commission, okay? Then the estimated useful life of that item. And then when we go to dispose of it, does it have any residual value? Are we going to get any money for selling it at the end of its useful life to us? Okay. So the way we calculate this, first of all, we take the cost that we calculated up here in number one. We subtract this estimated residual value. Okay. And that's going to give us the depreciable cost. So that's the cost we need to spread out over the life of this item. Okay. Now, how do we spread this across the period that we have this asset? Okay. There's a few different types. Okay. Some of these are more commonly used than others. I will tell you the most commonly used method of depreciation is the straight line method. Okay. Units of production is used for some manufacturing equipment. Still, they usually use straight line method. And then I'm going to be 100% accountant to accountants. Okay. Double declining balance is something that they teach you in school that you will never see again, ever. I mean, there is a depreciation method called MACRS, MACRs. It's only used for tax. It is a declining balance method that is similar. It'll be similar to double declining balance. But straight line is accepted for tax purposes. So most people just use straight line for their books and records and for their taxes. Okay. Again, I've been in this business a long time. I've never seen anybody use double declining balance, but I see it year after year. They force students to learn it. So we're going to learn it here. If you ever take the CPA exam, it's going to be on the CPA exam. It'll haunt you throughout your scholastic career if you go into accounting. Once you get out of school and get your certification, you will never see double declining balance again. That is the nicest thing I can say about it. Otherwise, I think it's convoluted and weird. Definitely not a huge fan, but I guess, the one nice thing is you won't see much of it. Okay. So, um, just want to refresh your memory. Okay, this isn't the data that we used before. Okay, so here's the data we're going to be working with for the next couple of slides. We've got a truck. It cost us $41,000. Its estimated residual value is $1,000, so we're going to be able to sell it for $1,000 once we're done using it. So we have to depreciate $40,000 over the useful life of this truck, which is 5 years. Okay. And then its estimated usage is going to be 100,000 miles. So we'll have it for 5 years or 100,000 miles or. Okay, straight line, most commonly used method of depreciation. Know this, remember it. You will be seeing this again in your business life, okay, even if you don't go into accounting. So with straight line, it is exactly what it says it is. You divide the entire depreciable cost over the entire useful life, okay? So our depreciable cost is going to be the cost of the item minus the residual value. So it's going to be 40,000 divided by the 5 years of useful life. So every year we're going to depreciate it by $8,000. What does that look like as a journal entry? We have depreciation expense of $8,000 and accumulated depreciation on the truck of $8,000. The accumulated depreciation is a contra asset, okay, to the book value of the item. Remember this from previous when we were talking about year-end closeouts and things like that. I know this book does everything backwards, right? But that accumulated depreciation was our contra account. So when you show an asset on your books, you'll say, truck, book value 40,000, less accumulated depreciation of 8,000. It's actually worth 32,000. Okay. That's how that's presented moving forward. Okay. That's probably more information than you wanted to know. But here is what it looks like on the income statement. Okay, under your property, plant, and equipment, you've got your truck. All right. Less the accumulated depreciation gives you the net value of that truck. Okay. This is a straight line depreciation schedule. So every year you are going to recognize another $8,000 of depreciation expense, okay, until your accumulated depreciation is $40,000. That's the amount that truck was worth, right? So you have nothing left that to value wise on that truck. You have, except for that 1,000 in residual value that is left over when we sell the vehicle. Okay. All right. So units of production. This is another method of depreciation where instead of using the useful life, you use the actual usage of the item. Usually this is used in factory equipment. We can make 2,000 widgets with this machine. So we use that to depreciate it instead of years. And I say that this method of depreciation is usually used in manufacturing, but that does not mean that manufacturing usually uses this units of production method. Anyway, So I think you can see where this is going with our truck. We are going to depreciate it based on those 100,000 miles worth of use. Okay. So, the depreciation per unit is going to be that cost minus the residual value. That's exactly the same as it was before. But this time we're going to divide it by our use. Well, they call it useful life. I think that's confusing because it makes it seem like it's an amount of time, right? I would say it's our use units, right? That 100,000 miles of use that we're going to get out of this car, okay, or this truck. So we have $41,000 minus that $1,000 of residual value divided by the 100,000 miles that we're going to use it for, okay? And that depreciates by 40 cents per mile, okay? So what does that look like on our books? Well, in this particular calculation, we are going to drive that truck 20,000 miles a year. So we just happen to also come up with $8,000 dollars of depreciation per year. Okay, it doesn't always work out this way where units of production will give you the same number as straight line. Okay, this is the units of production schedule. Again, each year you're just calculating the number of miles that you've traveled, and how much depreciation is going to go on the books based on that until you zero out that $40,000 value of the truck and sell it for 1,000. Okay. All right, double declining balance. We're here. Okay, I hate having to teach this. I think it's dumb, but here we go. Nobody's education is complete without learning, double declining balance. Ugh, whatever. All right, this is an accelerated depreciation method. All right, it's going to expense more of the asset's cost near the start of the asset's life and less at the end of its life. So, have you heard that old yarn about how, you know, um, as soon as you drive the car off a lot, it loses like half of its value. You purchase a new car, as soon as you drive it off the lot, it loses half its value. That is not strictly true, but that information is loosely based on double declining balance. And the idea is that some usable assets, especially vehicles and clothing, like designer clothing, depreciate at an accelerated rate at the beginning of their life. Okay, so they lose most of their value in the first period, and then their depreciation slows down. So there are different methods of accelerated depreciation. Like I said, makers is one of those. It's you legally are allowed to use makers for tax purposes. Most people don't use it. And then the main accelerated depreciation method is double declining balance. Okay. So we compute it in a couple of steps. Okay. So we are going to take, oh, goodness. Lost my place here. I was so horrified. I just lost control of my keyboard. Okay. So it's going to start off the same way straight line depreciation does. We're going to have cost minus our accumulated depreciation, okay, times 2 times 1 over the useful life, okay? So for the first year that we have this truck, we've got $41,000, okay, minus 0, because we just bought it. There's no accumulated depreciation yet. Times 2 times 1 out of 5 years. So this is the first of 5 years, okay? That will give us 16,400 in depreciation in the first year. Then in year 2, we take that cost, 41,000. We subtract accumulated depreciation so far, that's 16,400. That's what we calculated in year 1, times 2, times 1 over 5 years, okay? So that's going to give us $9,840 of depreciation in year 2. Does this make sense to you? If so, you were the first. So here's the schedule for double declining balance depreciation. Again, we're just depreciating down to this $4,000 floor and then selling the asset for $1,000 of residual value. Okay. Another summary slide. This compares the 3 methods of depreciation. Great study aid here. Okay. And then this is just words in pictures. So, showing you how the depreciation looks, depending on which method you use. Of course, straight line depreciation is the blue boxes. It's the same every single year. Units of production fluctuates depending on how much you're using that truck, right? You'll have different depreciation amounts each year. And then double declining balance, you get the largest amount of depreciation in the first year, and it goes down each additional year. Okay, so for tax purposes, the Internal Revenue Service requires that companies use modified accelerated cost recovery system, or MACRS. For tax purposes, that's not strictly true. You are permitted to use straight line depreciation. But for the purposes of this text, MACRS was invented for tax purposes. So under MACRS, your assets are divided into specific classes of items. So you have 3-year assets, 5-year assets, 7-year assets, and then 39-year properties. Okay, all items that you have to be plugged into these boxes in order to calculate their MACRS depreciation. Okay. The IRS specifies the life of the asset. You can't just say, okay, well, I'm going to have this thing for 13 years. It's got to be 3, 5, 7, or 39. Okay. Residual value is completely ignored. And of course, GAAP does not allow you to use MACRS. Okay. GAAP requires that you use straight line, units of production, or double declining balance. Spoiler, you're always going to use straight line. Okay, and then for a partial year, if you purchase an asset not on the first day of the year, which is more likely than not what's going to happen, then you only record depreciation for a portion of the year. You guys should be pretty versed in that. Works the same way we did with interest, right? Just keep in mind that we use a half-month convention for assets that are purchased somewhere in the middle of the month, okay? So if you purchase the item on or before the 15th of the month, you count that whole month. And then you don't record depreciation if it was after the 15th of the month. Okay, so it's an all or nothing thing. You remember how when we were doing a partial year for interest and payments and things like that, we would get down to the day. We divide by 365. We don't do that with depreciation. We just count months. Okay. And if it falls in the middle of the month, then 15 days or less, in the first 15 days, rather, we record depreciation. If it comes in the last 15 days, we don't record depreciation for that month. Okay. All right. So here's an example of that. Assume a truck costing $41,000 was placed into service on July 1st, 2026. It has a $1,000 residual value and a 5-year useful life. Okay, so we have this cost minus residual value. So that's 41,000 in cost minus 1,000 in residual value. Divided by 5 years is going to give us the amount of depreciation. But wait, we got it in July. So it's only 6 months, 6 of the 12 months. So instead of $8,000, you're only going to have $4,000 of depreciation in the first year. Okay. Okay, so depreciation is based on estimates, right? We just kind of estimated how long we'd be using the asset and what its residual value would be. But sometimes our estimate isn't perfect. Okay. So what happens if the useful life turns out to be longer than you thought it was? If that's the case, then as soon as you figure out that asset's going to last longer, we take the depreciation from the current year where we figured out that, and for the future years that we're going to own this thing, we recalculate our depreciation expense, okay, to spread it out over the remaining useful life. Okay, we don't have to restate our prior years. Okay. So for Smart Touch Learning, they purchased a truck on January 1st, 2026. The truck cost $41,000 and had a $1,000 residual value and a 5-year life. Okay. So they use straight line depreciation for the first 2 years. Okay. So they've accumulated $16,000 of depreciation. And the remaining depreciable book value is 25,000. Okay. But now they think that truck's going to last for 6 more years, right? So what do now? They take that 25,000 a book value that's left on that truck. They they subtract out the $1,000 in residual value, and then they divide that by the 6 remaining years that this truck is going to have. And now they're only depreciating it for $4,000 a year. Does that make sense? Okay, we realize, whoop, this thing's going to last longer. And we start at that moment with the new depreciation value. Okay, so in years 2028 to 2033, the yearly depreciation entry based on the new useful life would be depreciation expense and accumulated depreciation, each 4,000. Okay, so it's the exact same journal entry. It's just instead of being $8,000, it's now $4,000 because the truck lasted longer than we thought it would. We do not go back and restate the prior years. Okay. All right. All right. So property, plant, and equipment are reported at book value on the balance sheet. You can either, when you put them on your balance sheet, you can either report them as a single line item that's net of the accumulated depreciation, or you can do like they did in that slide near the beginning of the slide deck, where you have the book value of the item and accumulated depreciation as a separate line item and subtract that. okay? Um, so you can do it like this: building, less accumulated depreciation; furniture, less accumulated depreciation. Or you can say property, plant, and equipment, one number. It can be this simple. However, see how they say see note 8 here? This information is going to be in the notes to the financial statements because you have to disclose it anyway. So if you have a ton of different kinds of assets, oops, and you want to make your financial statements more streamlined, GAAP permits this presentation. Just keep in mind, you're still going to have to put this calculation in the notes, okay? All right. So, last thing we need to do is dispose of these plant assets, okay? Um, so you can discard this asset, you can sell it, or you can exchange it for another asset if you do a like kind exchange sort of thing. So let's look at how we would record that, okay? So the first thing you need to do when it's time to dispose of that asset is bring the depreciation up to date. All right. You want to remove the old disposed of asset and the associated accumulated depreciation from your books. Okay. You're going to record the value of any cash received or paid. Remember, I told you that you might have to pay someone to haul it away for you. And then you determine the amount of any gain or loss. Okay. So on July 1st, Smart Touch Learning discards equipment with a cost of $10,000 and accumulated depreciation of $10,000. All right. So the journal entry, accumulated depreciation, 10,000, equipment, 10,000. Okay, we're getting rid of that equipment now. All right. This is what it looks like in a T account, basically the same transaction. Okay. But let's suppose instead on July 1st, Smart Touch Learning discarded the equipment, which has a cost of $10,000, but is not fully depreciated. So accumulated depreciation is 8,000 and the annual depreciation is 1,000. Okay, so the first step is to bring the asset, oops, keep doing that. Okay, first we got to bring it up to date. All right. So we are disposing of it in July. Okay. So we're not going to have a full year's worth of depreciation. We only have half of the year, so it's 500. Okay, so we brought our depreciation up to date. Then we sell the equipment for $1,500. Okay. So we have the market value, that's what we sold it for. We've got the book cost less accumulated depreciation. So we have this on our books at $1,500. So we have no gain or loss here. We sold it for what it is worth on our books. Okay. So it would look like this. We've got cash of $1,500. We're closing out the accumulated depreciation account and we're closing out this equipment account. Okay. So what if we sold that equipment for $4,000 instead of $1,500? Okay. If we did that, we would subtract the value that we have left on our books of this asset of $1,500 from the $4,000 and we'd have a $2,500 gain. Remember, we've done this before. A gain or a loss, it's always a plug figure. Okay. So when we go up here, we've already got accumulated depreciation and equipment on our books. Okay. So now we just need to plug the amount, the difference between what we got in cash and what amount we have on our books. Okay. So in this case, we still got 8,500 on of depreciation, $10,000 worth of equipment. Okay. But we got $4,000 cash, so these two sides don't balance. So this gain of 2,500 is going to be our plug figure that makes these two sides balance. Okay? So what if we only sold the equipment for $500? So the equipment's on our books being worth 1,500, but we only get 500. So we're going to put it on our books as a $1,000 loss. Again, our accumulated depreciation and our equipment values are going to be the same. We only got $500 cash though. So to make these sides balance each other, we need to record a loss. All right. Here is a summary of what those different transactions look like and a summary of the associated journal entries. Let me see how we're doing on time. Ooh, right on time. Okay. Last, we're going to talk about accounting for natural resources. Okay. Those are things that come from the earth and that are consumed. They have a finite life. We don't call that depreciation. In this case, we call it depletion. So if you have a coal mine or an oil well, there's only a finite amount of coal or oil there. So we need to record how it is depleted over time. Okay. We use units of production for this also. Okay. So it can be used to depreciate factory equipment. They do commonly use it for recording natural resources. Okay. So you bought an oil well, it's $700,000 and it holds 70,000 barrels of oil. There's no residual value for an empty hole in the ground, right? So we extract 3,000 barrels during this year. Okay. So this is how we record depletion. It looks a lot like depreciation, right? But because it's a natural resource, we call it depletion. So we have cost minus residual value divided by the total units. Okay, so that's $700,000 in cost. There's no residual value because nobody wants a hole in the ground. Divide that by 70,000 barrels. It's $10 per barrel. Okay. So our depletion expense, that's going to be our $10 per barrel times the 3,000 barrels that we pulled out this year. So this year we have depleted this oil reserve by $30,000. Okay, and this is what the journal entry is going to look like. Depletion expense, 30,000. Accumulated depletion on these oil reserves, also 30,000. Okay. Again, accumulated depletion, it's the contra asset to the oil reserve asset, just like accumulated depreciation. Really, it's the same thing. It's just, a different type of asset. Okay. Oh, and one other thing, intangible assets. Okay. So these are items that do not have a physical form. Okay. So patents, copyrights, trademarks, goodwill, things like that. Okay. They are on our books, but we don't have a tangible physical thing to represent them. Okay. So these intangible assets are always going to be recorded at cost. Usually we expense them through amortization. All right. That's the allocation of an intangible asset to expense over its useful life. How is that different from depreciation? There's no accumulated account. Okay. Also, only intangible assets with a definite life are going to be amortized. Okay. So, anything that doesn't have a definite life, like say goodwill, you know how if you have a copyright, it only lasts for a certain number of years. You only have exclusive rights to that thing for a finite number of years. Okay. Something like goodwill or R&D, you don't really know how long that's going to last for. Okay. So what we have to do is test it occasionally for impairment. Okay. Impairment means the fair value of that asset is less than the book value. Okay. And when that happens, we just record a loss on our books. We write down the value of that item and we record the difference in a loss. Okay. So a specific example of this would be a patent. Um, it is a federal grant that gives you exclusive rights to a product for 20 years. All right. And it could be a process, a product, or a formula. It doesn't have to be a product. All right. So the acquisition cost of a patent is debited to the patent account. All right. So assume Smart Touch Learning pays $200,000 to acquire a patent on January 1st. So the patent is $20,000 or 200,000 and we paid 200,000 for it. So we're just swapping one asset for another. Easy peasy, we do that all the time. Then when we acquire this, there's only 5 years left on this patent. Is he back?
We have a bird sighting.
Oh, okay.
I'm gonna go.
Okay. Sorry about that. I have a pet that ran away from home, and so my whole family is outside, combing the neighborhood while I'm teaching you guys. So, if you're the thoughts and prayers type, we could use those. Okay, so we bought this patent. We bought it for $200,000. Technically, the entire life of the patent is 20 years, but we only have 5 years left on it. Okay. So what we're going to do to amortize the expense, we've got cost minus residual value divided by the useful life. So that's $200,000. There's no residual value because we're going to use it all the way up. We divide that by 5 years and we have to amortize it by $40,000 per year. Okay. So notice that it goes directly to amortization expense and you write down the patent. There's no accumulated amortization. That's not a thing. So that's how this differs from depreciation. Okay. All right. So a copyright is an exclusive right to reproduce and sell a book, musical composition, film, or other work of art. Okay. That goes for the life of the creator plus 70 years. And then a trademark, that is an asset that represents a distinctive identification of a product. So like the Nike swoosh or the McDonald's Golden Arches, legally protected slogans like just do it or a diamond is forever, are also examples of trademark. Okay. Then franchises, those are privileges that are granted to a business to sell goods or services under specified conditions. So you're selling a trademarked product. And then licenses are privileges granted by the government to use public property in performing services. Okay, just some vocabulary. You know, I love to put that on your tests. Okay. Okay, goodwill. I talked a little bit about this. This is the value that's paid above the net worth of a company's assets and liabilities. So when you buy another company, you don't actually buy the company. A company isn't a thing, it's people and whatnot. You buy that company's assets. That's how it's valued on your books. So if they only have $50,000 worth of stuff, but you bought them for $100,000, then that other 50,000 goes on your books as goodwill. Okay. You do not amortize goodwill. All right. airy-fairy kind of, we don't really know why you paid more than the company was worth sort of thing. So we tell you you cannot amortize that. Okay. Here is an example of how we calculate that. Okay, White Corporation acquired Mocha Inc. on January 1st. The sum of the market values of Mocha's assets was 9 million and its liabilities are 1 million. So Mocha's net assets are 8 million, but White paid 10 million. So it's only worth 8, but we paid 10. Okay. So we record the additional $2 million as goodwill. Okay. And it just sits on our books because we're not allowed to amortize that. This is what the journal entry looks like for that. Again, goodwill is a plug figure. Okay. Again, a summary of the different ways that we expense items over time. Okay, assets are depreciated, natural resources are depleted, and intangible assets are amortized, except goodwill. Okay, do you guys have any questions about anything that we covered today?